Let's get to Tom White. And he's taking a look here of Schwab Network. He's here, Fast Market, taking a look at the numbers and the interpretation as it's all breaking now. Tom.
Hey, Nicole. Yeah, no surprise here. 25 basis point cut. The CME Fed Watch tool basically had that baked in. The market did also. Now you have to start wondering, about inflationary expectations and how many rate cuts they're expecting. Well, it looks like the dot plots moved down to only 2 cuts in 2025, and they revised up their 2025 inflation for their end of 2025 inflation projections to 2.5%. On core and headline, and the medium long run dot rises to 3%. There was one dissenter on this, and this was Cleveland Fed President Beth Hammack. She dissented on this vote. So nearly a unanimous decision here, but not surprising that we're seeing a little bit of a pullback here in equities. I think people are, just biding their time because this 25 basis point cut was expected by the market. Now it's all going to be focused on Fed Chair Powell, what type of commentary he gives. Is it going to be a little bit more hawkish like the market expects at this point? That's what I think you have to focus on here moving forward, Nicole.
Yeah, we're starting to get some of the headlines that the Fed is still considering the extent and timing of additional adjustments. Good point. Great that you quickly caught on there. Thank you for telling us about the 2 cuts. I was under the impression, we were originally thinking 3 cuts, so it looks like that's changing. We still have concerns about inflation. Projections here from the Fed, average of 2 cuts next year, down from 4. So it was 4 for next year. I didn't realize that. I thought it was 3. That being said, now the Fed has a lot to now digest and not show too much one way or the other. I mean, that'll be the Fed Speak challenge of the day today. Are you listening for anything in particular later?
Yeah, I mean, I think if you hear Fed Chair Powell talk about their path of inflation, it's been stunted as far as the descendancy of inflation, because we saw it out of the last PCE report in November. That ticked up to 2.5%, 2.9% on core. And then if you look at the CPI and PPI inflationary data, it's firmly above the 2% mandate that the Fed has in place at this point. So I think a lot of the conversation and maybe some of the questions should be, hey, where do you see inflation moving? Because it seems to have stalled out as far as that trend going lower, and it's now starting to reignite a little bit. You're seeing that reflected in the 10-year yield, which is back above 4.4% at this point. So there's going to be some tough questions that Fed Chair Powell has to answer. I think he's navigated the soft landing pretty well, but now we're starting to see the impact of maybe that 50 basis point cut that they did in September that reignited maybe the GDP numbers. We're going to get some commentary out of that in their fiscal projections moving forward. Atlanta Fed GDP now went up to 3.2% just this week. So how they navigate the fact that inflation's not going down anymore, the consumer is still robust at this point. GDP numbers are still above the 3% level at this point. So what does this do as far as another 25 basis points? I get that. It's only a 25 basis point cut. It shouldn't really matter in the long term. But now they're cutting their projections from 4 cuts of 25 basis points in 2025 down to 2. So there's going to be some tough questions that he's going to have to answer, because that last stretch of inflation down to their 2% mandate has become an even tougher job for the Fed and for Jerome Powell at this point, Nicole.
Yeah, and we're seeing in some of the language and some of the stories coming out now pertaining to the tariffs, right? And President Trump, who's going to come into office, is likely to impose some tariffs, and how those are likely to boost inflation. And it looks like he's taking a hedge and saying it may not mimic what we saw way back when in 2018 and such, but so we will see what that means. But I guess they have to deal with sort of a new element at that time and a different inflationary environment than it was when he was president 45. And I'm sure you're not surprised to see, last but not least, that the 10-year bond yield is now at 4.44. Yeah. So fewer cuts, and the long yield here is sneaking higher, right? We were 4.39, now at 4.44. Tom, great to have you to break down this breaking news. Appreciate it.
Thanks.
Tom White.